Hello, this is Stacy Francis from Francis Financial, and we're very excited about our 2015 investment forecast and first quarter review. So let's go ahead and get started, but I want to make sure that everybody can both see and hear me. And I just want to make sure, can you see the screen? And if you could respond to that. Okay, we're getting a lot of responses to that. And can you hear me? And for that, if you can just kindly say, yes, I can, then I'll know that you're responding to that second one. All right, perfect. It looks like we are good to go. Welcome, welcome, welcome. So my name is Stacy Francis. I founded Francis Financial about 13 years ago, and it has been an absolute dream. And the company that we have created here is something that I get so excited for the fact that every day I can come to work. I absolutely adore what I do. So I'm going to apologize in advance for the fact that most likely I'm going to be going into a lot of detail, but also talking in a very excited way about where we are, both with the economy as well as with our investments, because now is a very historic time and there's a lot of great opportunity out there. A quick second or two about Francis Financial. We are an independent wealth management firm. We are fee only. That means that we don't accept commissions from the sale of insurance products such as life insurance, disability, or selling investments where you might get a load for selling one mutual fund or another. We don't believe that that necessarily gives unbiased advice, and we are very committed to that. We have a specialty of working with women going through transition, and so we work with many women going through divorce and after, and unfortunately women who might have lost a spouse. So many of our clients, couples as well, are going through transition, and during these times need a lot of hand-holding, and their portfolio needs to reflect that as well. So let's talk a little bit about what happened in the last couple quarters. We're going to talk about our market review and then also the investment outlook and portfolio positioning for our portfolios. So we're going to look at this market review, and U.S. stocks were slightly positive this quarter despite some lackluster economic data. And there also were some downward revisions to earnings growth and revenue growth estimates here in the U.S. One of the biggest notable changes, essentially a trend that we have been talking about now for the last several months, is the trend that we expect a reversal. Over the past several years, U.S. stocks have performed extremely well, actually outpacing their international stock counterparts, but we've seen the relationship flip and very much have seen that both developed international and emerging market stocks outperformed, did much better than U.S. stocks over the last several months. The international stocks were boosted by many reasons, but one of the main reasons because of the Eurozone and their QE program. It's also called quantitative easing. This was a program that the U.S. embarked upon several years ago and has been one of the main reasons why the U.S. economy has continued to recover, and the U.S. stock market has done so well over the last couple years. So while emerging market stocks have been benefiting from this, we saw in particular two countries that really knocked it out of the park, and that was China as well as India. Overall, we experienced the fifth consecutive quarterly gain for core bonds. And you can see on the right here that core bonds had a 1.62% return in the last 3 months in that first quarter of 2015. The other big earners, as we mentioned, floating rate loans, and we've got a very good exposure to floating rate loans, getting 2.13% return in 3 months from bonds, which typically are very conservative, is phenomenal. An annual return there is almost potentially a 9% return if it stays on this unbelievable track. The big story is that developed international stock portion, we had 5.62% return. If that return stays at that same blistering pace, we're looking at over a 20% return for 2015, which would be unbelievable, unbelievable. So let's go ahead and talk a little bit about our outlook and our positioning. So how do we take advantage of this? In particular, there's a lot going on in the economy. First, we've all heard about the rise of the dollar against a very broad range of foreign currencies. That was one of the most significant key developments for all of 2014. And in fact, in December 2014, the U.S. dollar hit its highest level since March 2006. March 2006. And it's appreciated just in 2015, 12% for the year. The dollar's strength, where is it coming from? Why is the dollar surging in value now? Well, there's a couple reasons. Number one is that we're seeing superior growth characteristics of the U.S. economy and relatively high Treasury yields compared to government bonds from other countries. What that's doing is that is attracting many international investors to the U.S. that are putting money into the U.S., both through real estate, through buying treasuries, and it's giving that upward pressure, that higher value of the U.S. dollar. That's our most significant story for 2014 that we're taking into consideration for this next year. So what does that equal? Overall, our view and assessments of the returns across different major asset classes, and when I say asset classes, I mean the risks among stocks, U.S. stocks, international stocks, bonds, and so forth, it's not really changed meaningfully over these last 3 months, this last quarter. We believe in this base case scenario. And the base case scenario, in that scenario, we continue to see that the U.S. economy and also the global economy more broadly is going to continue on this slow path of recovery that we've seen since the 2008 financial crisis. And that base case, just to dive into it a little bit more, is that we believe that we are going to continue to have that moderate economic recovery, that it continues with no major economic crisis, but a normal recession that is likely to happen within a 5-year time frame. It assumes that GDP, gross domestic product growth rates, and interest rates also, they start to normalize towards the end of that 5-year horizon. A bull case, what we hope occurs is that we would have an average earnings period above the long-term trend line. Essentially, we would see much greater returns than what we've seen historically, and it would be helped by a stronger non-U.S. growth, so stronger international growth, and also the consumer buying more, getting more active, as well as corporate investment spending, and also the growth cycles internationally. There's also the bear case. And I'm not going to spend a lot of time on that bear case because it's something that we do not see as having significant likelihood of occurring going forward. But it's something that we always do make sure that we have some exposure to protect against this. So I will tell you that I am biased. I am biased, as we are all, that even though we are currently seeing all of our models pointing to a base case that would last and take us through the next 5 years or so, we hope that bull case occurs, because that bull case would return much higher returns both from our U.S. stock as well as our international stock. I will tell you that we are so hoping that would occur that when we went to go move offices about a year and a half ago, and I was looking at the different offices available in the commercial district down here in downtown Manhattan, I fell in love with one office. And I will tell you, it's the office that I'm talking to you from today. And number one, It's a great building, historic, beautiful, a wide open space, but I will tell you something that I thought was just as important. A half a block away is the historic Bull of Wall Street. That bull is visited by hundreds of thousands of visitors each year from all different corners of the world. And it is a representation of what we are, who we are, capitalism, and the bull market of the stock market. So we will have to see, of course, but we all hope for that bull case, even though what our models are telling us is right now, going forward, most likely you're going to see a base case. So overall, the U.S. economy appears to be in good shape. However, we've had a few headwinds that make us a little concerned that the types of returns that we've seen in the last couple of years, which have been pretty heady, pretty high, quite significant, are going to be more difficult to attain. So this is a wonderful chart, and it's showing you the labor market. And we go all the way back to 2006. We have a period where in 2008 into 2009, we saw negative growth in the labor market. But since then, 2010, we've had much healthier data coming in. The only problem is, look what happened. From the fourth quarter, we had a really nice number, and then it dropped. Q1 data, unfortunately, was disappointing. That's one of the many different things that we look at. As the labor market continues to strengthen, there are some positives in that inflation is remaining low, manufacturing and indexes and some other economic indicators are growing solidly, and falling oil prices have actually helped the economy too. And that is because it is boosting consumer spending. As less dollars have to go towards filling up your gas tank at the gas station, more dollars are available for other consumer spending. We have seen some softer economic data recently, and that's actually very likely due to the very harsh winter that we saw, as well as the strengthening U.S. dollar. But overall, the U.S. economy appears to be on a positive uptrend. While economic backdrop still looks pretty supportive over the near term because of many of the things I just spoke about. Number one, solid gross domestic product growth, falling oil prices, subdued inflation, and a economy that we are seeing the labor market continue to strengthen. We are concerned that our reviews, they remain that U.S. stocks, they've unfortunately moved too far upwards a little too fast. And it's going to make it difficult for them to continue that blistering pace. So let's talk a little bit about corporate profit margins. Corporate profit margins are at an all-time high. And unfortunately, we don't believe it's sustainable over the long term. Here we have the average net margin. And you can see that we're much higher than that where we are currently. The two key factors driving our view that these corporate profits cannot necessarily be sustainable for the long term and that they'll revert back to the mean is that current earnings are not necessarily sustainable and valuations are somewhat expensive. Means is that we expect that U.S. stocks over the next 5 years to return more so low single digits over the next 5 years. Unfortunately, we don't believe that overweighting, putting more money in U.S. stocks than we normally would, will really compensate us for the downside risk of actually holding them. So another factor that we look at is the median price to sales ratio. The S&P 500 median price to sales ratio, as shown in this chart, it's at an all-time high. You can see that right over here in the far right-hand corner. It's more than twice its historical median. To get a truer picture of the valuation risk, you have to look at all three factors of these things together, both price to sales, price to earnings, and also historically high profit margins. These are many of the things we look at. But overall, unfortunately, this goes to show that the data is showing that U.S. stocks, unfortunately, are a little bit expensive. So what about the rest of the world? We believe that European stock market and valuation multiples will at least be in line with their long-term normal amount and consistent with an economic earnings recovery. As such, when we model out that expected 5-year return for developed international stocks, we get returns of around, I hope you're sitting down here, we get returns of around 10 to 11% each year over the next 5 years. Now, if you recall on that first chart, what we saw in the first quarter alone in 3 months was 5.62% in developed international. So you can see that the performance already is showing that 10 to 11% return for the year is actually quite likely. We're on par for that. And part of this is because we see that international stocks are trading at much lower levels than U.S. Essentially, as stocks go through cycles, it's definitely impossible to predict which market's going to outperform, whether it's U.S. or international. It's really important to get the timing right. And the best way that we can figure out what the timing is looking at how are they priced. Are they expensive or are there deals to be had? And you can see here in the red dotted line that U.S. stocks seem to be a little bit more expensive and many more opportunities here within the shorter term range. So what about, other than just European stocks, what about emerging market stocks? Well, interestingly enough, emerging market stocks we see as very similar to Europe in that their valuations look extremely attractive for, in particular, long-term investing. We know, of course, that emerging market stocks, they face some extremely unique risks, and in no way do we discount them. Some of the risks that we're concerned about is an economic slowdown in China, and then also a second risk is the negative impact from the strong U.S. dollar. Many emerging market companies hold debt in U.S. dollars. And because the U.S. dollar appreciating, going up, it makes these debts more expensive to pay back. This can lead to increased investor fear, potentially a flight of capital out of the emerging market country, and cause further currency depreciation, which would not be good for them in any way. So these are some concerns we have. And while we are invested in emerging markets, and you can see that the valuations are much lower for emerging market stocks here in this beautiful, beautiful mint green color, and the teal up here of U.S. stocks, you can see there's a lot of opportunity. So yes, we are invested in emerging markets. However, we are not over allocated. And the main reason why we are not over allocated is because of the inherent concerns that we have about emerging market countries and the shock that it could have on our holdings of them. So what do you do with the other concern? The concern that we've been talking about for what feels like years. And that concern is increasing interest rates. We know that we are at historic lows for interest rates, and it's fantastic if you are buying a home. We have clients who are refinancing their mortgage who just took their mortgage out only 2 years ago. It's an historic time. So what do you do? What do you do when interest rates go up? Well, flexible and unconstrained bonds are very important, and we're using them, and they look very attractive relative to core bond indexes. The fund's much lower durations means that they face less negative price impacts from that rising interest rates. And floating rate bonds actually benefit from rising interest rates. Why? Because floating rate loans, when interest rates rise, guess what? You make money. The floating rate loans, you actually have a higher return. For lower duration bonds, that's important. That means that they have a shorter maturity, a shorter amount of time until you get your money back. And we know that the relationship to interest rates and the price of bonds is inverse. So that when interest rates go up, bond prices fall. And that's a fancy way of saying that your bonds lose money. So what do you do? So here is a great example of a time when we saw rising rates and what can happen to bonds. So rates rose a little bit in 2013 into 2014. Core bonds, which we own very little of, were down a little over 3%. Double Line, which is a fund we own, down 2%. Osterweiss actually up 2.5%. We also had Legg Mason at 1%, and a few others. The floating rates up 2.5%. So why is it that some bond funds actually made money during rising rates and others lost money? It's because of essentially making sure that the bonds you buy have less interest rate sensitivity. Bonds that have less sensitive to interest rates are, number one, shorter duration or shorter maturity. Number two, they have high yields. And number three, they're often in the area of floating rate loans. So that's what we're doing to protect our clients from that interest rate risk, because no one has a crystal ball and no one can necessarily say when interest rates are going to rise, but you do need to be prepared. So we've tilted our portfolios towards these options. And specifically, in light of interest rates rising, we've shifted more than half of our bond exposure to more active management. And that's because these mutual funds, the managers within them, have the flexibility to manage their interest rate risk. And because of that, they're doing much, much better in reducing the overall exposure. We believe that having smart, skilled, proven managers protect your portfolio from interest rate increases, interest rate rises, is extremely important. So this is a wonderful chart that shows that we have higher yielding bonds that result in lower risks from rising rates. How you read this chart is that here on this axis we have yields, and below we have interest rate sensitivity. Bond market index has a lower yield and the highest interest rate sensitivity of many different funds. Where are we? Well, these are where most of our holdings are. They're higher yields, and you can see they're less sensitive to interest rates, with a 0 being the least amount of sensitivity to interest rates. This is important, and it's something that we encourage everyone to look at, because your bond exposure is important. Everybody needs bonds as part of their asset class. However, no one ever expects to lose money from bonds, and I'm sure nor do you. So what do we expect over the next couple years? When we think about what's going to happen to your portfolio, it's very hard to determine what's going to happen today or tomorrow, or even the next couple months. But we can have much more confidence in prospects going forward over the next 5 years. Now this chart shows you the very wide dispersions of expected returns for different asset classes. The bold horizontal bars right here, they show you the return estimates for that base case scenario that I said that we are in currently and expect over the next 5 years. This high-low point, this high point and this low point of each asset class represents the best and therefore also the worst case scenario return. So what I think is interesting is that you don't see a whole lot of dispersion here in the fixed income, the bond area, but you see unusually wide expected returns for U.S. stocks, European stocks, and also emerging market stocks. And that means that for U.S. stocks, we could have returns of up around 9-10% each year over the next 5 years, but we could also have a negative 5%. That's based a lot on the pace at which the U.S. continues to recover and also what occurs both internationally for European as well as emerging markets. For European stocks, this has an impact for whether or not the quantitative easing in Europe and that there are no new major crises over the next 5 years. Major crisis, we see negative 5%. Everything going our right way, returns of about 17% each year. And the same thing for emerging market stocks. Emerging market stocks, the real low of a return of maybe about 7% would be if China essentially blows up. The higher 20% return is that China continues to be a very big contributor to the overall emerging market stock market growth going forward. So if you don't like to see graphs like this, we also created a chart for you, and I'm happy to send this presentation to anyone here on this call. This essentially just shows you, again, for the base case, the wide dispersion between returns. As I said, we would love for this bull case to occur because look at these returns. U.S. equity is a 9.7% return, developed international 18%, emerging markets 20%, floating rate loans, which we've got a good exposure to, 6%. This is what we hope occurs, but right now all of our data is showing more so that a base case scenario is most likely. So what does this mean for you? Well, overall, we are underallocated in traditional investment grade bonds. We are underallocated because we know that they are much more sensitive to interest rates rising. Instead, we are overallocated to more flexible strategies that can perform well even with rising interest rates. And that is both from absolute return oriented as well as floating rate loans. For equities, U.S. large cap stocks, we're slightly underallocated. Smaller companies, we're slightly underallocated. And foreign stocks, depending on the client, foreign stocks neutral. Some clients are underallocated that don't want as an exposure to international because they don't feel comfortable with it. And emerging markets, neutral for some people, again, that don't want overexposure there. And then those clients are willing to take on more risk, overallocated. So what do? Ultimately, what comes down to the most important decision you can make about your portfolio, it is having a broad exposure to many different asset classes. That means making sure that you stay invested with bonds, U.S. stocks, and international stock. There are times when you may want to weight international more than others, which we're doing right now. But you should always remain invested in all different asset classes because 90% of your investment return comes from being in a properly diversified portfolio. and the percentage of money that you put in large company stocks versus international stocks versus bonds. And then the other 10%, well, that's picking the perfect investment that shoots up. It's picking the right time to invest and take your money out. It's, unfortunately, those smaller things that everyone focuses on. But again, 90% of your returns is just your asset mix between stocks and bonds. So I hope that this gives you some food for thought, that you look at your portfolio, that you spend as much time looking at your portfolio as you do planning your summer vacation, and that if you haven't worked with a financial advisor, that you look to one. We offer a second opinion review, and in that second opinion review, we will go through and look at every piece of your portfolio, having an open dialogue about your values, your goals, and what plan is right for you. This is something that we offer without a charge because we find that you get so much value out of that. And 3 things can happen. Number 1, it could be that everything looks perfect, and you can go back to that financial advisor feeling confident that your portfolio is working as hard as you are. 2, it could be that there are some tweaks that need to be made, but we're not necessarily the right firm for you, and we'll happily introduce you to a firm that might mesh with your needs and serve your needs better. And finally, we might be the right fit, and if so, that would be great, and we'd love to help you. So if you have any questions, please let us know. My name is Stacy Francis, and you can reach me at 212-374-9008 or stacy@francisfinancial.com. Have a great day, be prosperous, and most importantly, be happy.